Gold. A single word, yet it conjures images of opulence, adventure, and intrigue. For centuries, this precious metal has captivated the human imagination, inspiring explorers, shaping empires, and fueling legends. But what is it about gold that gives it such enduring allure? For millennia, this metal has symbolized wealth and power. From the treasures of ancient pharaohs to the crowns of medieval kings, gold has been a universal marker of status and prosperity. Its rarity and beauty have made it a coveted prize, sparking quests and conquests across continents. Today, gold is more than just a symbol. Beyond its use in jewelry and electronics, it stands as a global commodity, traded around the clock in bustling markets from London to New York to Shanghai. Every day, fortunes are made and lost as traders buy and sell gold, seeking to profit from its ever-changing value. Its price is in constant motion, swayed by a complex web of factors: supply, demand, and even the collective emotions of investors. A single headline or economic report can send prices soaring or tumbling within minutes. Understanding these movements isn't just about tracking numbers on a screen. It's about peering into the heart of the global economy. Gold's price tells a story of confidence and fear, of growth and uncertainty, of the world's shifting fortunes. The price reflects decisions made in the halls of government, in the boardrooms of central banks, and in the hands of everyday investors. Each transaction, whether by a nation or an individual, adds another thread to the intricate tapestry of the gold market. Imagine the gold market as a never-ending auction, where buyers and sellers from every corner of the globe compete, negotiate, and react in real time. The energy is palpable, the stakes are high, and the outcome is always uncertain. Every day, buyers and sellers respond to a barrage of news, economic data, political developments, and even rumors. A sudden crisis or a surprising policy announcement can shift the balance in an instant, sending ripples through the market. When more buyers rush in than sellers, prices climb higher. When sellers outnumber buyers, prices fall. This constant push and pull creates the dynamic, ever-changing landscape of gold trading. At its core, the principle of supply and demand underpins every movement in gold's price. But unlike many commodities, gold's supply is relatively fixed. Mining is slow and costly, and most of the gold ever mined still exists today, locked away in vaults or worn as jewelry. Gold is more than just a commodity. It's a barometer for human emotion. In times of fear, investors flock to gold as a safe haven. In times of confidence, they may seek riskier assets. This emotional tug-of-war is reflected in every price movement, making gold a unique and tangible asset in the world of finance. Its value is most often measured in US dollars, creating a dynamic relationship between the two. When the dollar strengthens, gold can become more expensive for buyers using other currencies, often leading to a drop in demand and price. Conversely, when the dollar weakens, gold becomes more attractive, and its price tends to rise. This interplay is a key factor for investors and central banks alike, influencing decisions on a global scale. But the story doesn't end there. Geopolitical tensions, wars, elections, trade disputes, and central bank decisions on interest rates or monetary policy can all send shockwaves through the gold market, amplifying its volatility. Recent dips in gold prices are a vivid illustration of these powerful forces at work. By understanding the factors that drive gold, we gain a window into the world's economic pulse and the hopes and fears that shape our financial future. In uncertain times, investors seek safe assets. Gold is the ultimate safe haven, valued universally. During crises, people flock to gold, a tangible asset. News of conflict or instability boosts gold demand. This demand surge, with constant supply, raises prices. Gold shines brighter as market anxiety grows. Unlike stocks or currencies, gold has intrinsic value. Its scarcity and history make it appealing. Recent geopolitical events spurred a gold rally. Fear drove prices to impressive highs. What rises must pause, leading to profit-taking. Investors sell gold after price surges to lock gains. This collective selling creates pressure, lowering prices. It's a strategic move, not a lack of faith in gold. Profit-taking prevents overvaluation and allows market consolidation. The initial geopolitical scare fueled the rally. As clarity emerges, urgency to buy gold fades. This lull lets investors convert gains to cash. Spot gold's recent drop exemplifies this. Human decisions drive market movements. Understanding profit-taking is key to interpreting price swings. The US dollar and gold have long shared a fascinating, inverse relationship that shapes the global financial landscape. When the dollar strengthens, gold often loses its shine, and when the dollar weakens, gold tends to glitter brighter in the eyes of investors. This dynamic is at the heart of a global tug-of-war, influencing decisions from Wall Street to international markets. For foreign investors, a robust US dollar means that buying gold becomes more expensive in their local currencies. This price hike can discourage international demand, as investors may look for more affordable alternatives or simply wait for a more favorable exchange rate. As a result, gold prices often face downward pressure, with demand softening and sellers outnumbering buyers. This can lead to sharp corrections in the gold market, especially during periods of rapid dollar appreciation. Recently, even a modest rebound in the dollar was enough to push gold prices lower, highlighting just how sensitive the precious metal is to currency fluctuations. For international buyers, every uptick in the dollar's value translates to a higher cost for gold, making it less appealing as a safe haven or investment. This acts as a persistent headwind for gold, limiting its ability to rally even when other factors, like geopolitical tensions or inflation fears, might otherwise boost demand. The dollar's strength is often seen as a signal of risk-off sentiment in the markets, where investors flock to the safety of cash and U.S. assets, leaving gold behind. Today, a combination of dollar firming and profit-taking by traders put additional pressure on gold, causing its price to slip further. As the dollar recovers, gold becomes less attractive to global investors, who may shift their focus to other assets or simply hold on to cash. Gold's price is never isolated. It's constantly influenced by the ebb and flow of currency markets, especially the movements of the US dollar. The dollar plays a leading role in setting the tone for gold's pricing, acting as both a benchmark and a barrier, depending on its direction. For anyone navigating today's markets, keeping a close eye on both the dollar and gold is essential to understanding the bigger picture and making informed investment decisions. Gold's rally was triggered by US-Venezuela tensions. A US attack and capture of Venezuela's president shocked markets. This major event sparked a flight to safety. Investors sold riskier assets and bought gold. Gold demand soared as fear of conflict rose. Prices climbed with perceived risk. As tensions eased, profit-taking began. The Venezuela crisis was the rally's catalyst. Gold's movements affect other metals. Silver, platinum, and copper followed gold's trajectory. Silver surged with gold, then dropped sharply. Platinum and copper also saw price shifts. The strengthening dollar pressured all metals. Profit-taking hit the entire metals complex. No commodity exists in isolation. Observing other metals gives market insight. The pullback was driven by macroeconomic factors. Focus shifts from Venezuela to U.S. economic data. The U.S. jobs report is one of the most anticipated economic indicators, providing a snapshot of the country's employment situation. Investors, policymakers, and analysts eagerly await its release. The upcoming jobs report is a key market mover. Released monthly, it offers insights into job growth, unemployment rates, and wage trends. These metrics are crucial for understanding the health of the economy. It shows U.S. job growth, unemployment, and wages. A detailed analysis of these figures can reveal underlying trends and potential future economic conditions. For instance, rising employment numbers typically indicate economic expansion. A strong report boosts confidence, hurting gold. When the job market is robust, investors feel more optimistic about the economy, leading to higher stock prices and a stronger dollar. This often results in a decline in gold prices as investors shift to riskier assets. A weak report stokes fears, benefiting gold. Conversely, if the report shows poor job growth or rising unemployment, it can trigger concerns about economic stability. In such scenarios, gold often becomes a safe haven for investors. The report influences Federal Reserve decisions. The Federal Reserve closely monitors employment data to guide its monetary policy. Strong job growth might lead to interest rate hikes, while weak data could prompt more accommodative measures. Traders will scrutinize it for monetary policy clues. Every detail in the report is analyzed to predict the Fed's next move. This anticipation can lead to significant market volatility. Gold is in a holding pattern, awaiting this data. The precious metal's price often remains stable in the days leading up to the report, as traders wait for clear signals. Profit-taking is partly due to this shift in focus. As the report's release approaches, some investors might sell off gold to lock in profits, anticipating market movements post-report. The jobs report could reignite or lower gold prices. Depending on the data, gold could either surge if the report is weak or decline if the report is strong. It will set the market's tone and influence the Fed. The jobs report is more than just numbers. It's a powerful indicator that shapes economic expectations and policy decisions. The Fed's interest rate decisions impact gold. Higher rates make bonds more attractive than gold. Lower rates reduce the opportunity cost of holding gold. The market expects more Fed rate cuts. This supports gold's value amid geopolitical tensions. The jobs report affects the Fed's rate decisions. A weak report supports rate cuts, boosting gold. A strong report could halt rate cuts, hurting gold. The Fed's policy outlook influences gold's long-term trend. Economic data guides the Fed's path and gold's future. Gold's price reflects global confidence. It's a financial barometer for fear and stability. Gold diversifies portfolios, acting as insurance. Recent events highlight gold's role in diversification. Profit-taking shows no asset rises endlessly. Understanding market moves aids informed decisions. The jobs report and Fed decisions impact investments. Economic data has real-world investment consequences. Gold's dip is a healthy correction after a rally. Long-term, gold remains a safe haven and diversification tool.